Wondering how to jump into the stock market but feeling overwhelmed? Then this video is for you. In this video, we'll talk about a powerhouse of the stock market, the S&P 500 index. But how do you, as a beginner, actually invest in this giant? Enter the S&P 500 exchange-traded funds, or better known as ETFs, your access to start investing in the S&P 500. And before we dig in, give that subscribe button some love. And don't forget to like the video so the algorithm experts at YouTube know they got it right showing this video to you. So what is the S&P 500? It's a stock market index that tracks the performance of 500 leading publicly traded companies in the United States. Think of it as a basket holding all these successful businesses. And if you're curious what the requirements are for companies to be part of the S&P 500, I'll include a link in the description to those details. Now that we know what the S&P 500 is, what about those ETFs? What exactly are they? ETFs are a lot like mutual funds, but one big difference is that ETFs are actively traded, meaning you can buy and sell them just like you can a stock throughout the trading day. When you purchase an S&P 500 ETF like SPY or VOO, or should I say SPY or VOO? Anyway, you're buying into that basket holding all of those companies we mentioned earlier in the S&P 500. So why are S&P 500 ETFs great for beginners? When you purchase an S&P 500 ETF, you're getting an investment that gives you instant diversification in some of the best companies to invest in. And why is diversification so important? It helps to spread your investment risk across all of these companies. Just ask those that worked for Enron in the early 2000s how important diversification is. Many of their employees had their retirement investments tied up mostly in Enron stock and lost it all when the company went bankrupt after illegal accounting practices led to several Enron executives being sentenced for their fraudulent activities. And that's why diversifying your investments is so important. Another reason S&P 500 ETFs are good for beginners is they typically have lower fees, also known as expense ratios, compared to other ETFs or mutual funds. These fees can eat away at your earnings, so it's definitely something worth paying attention to. To show the impact of these expenses, here's an example of two different investments of $10,000 that have the same exact return of 6% per year over 30 years, but have different expense ratios of 0.15% and 0.75%. The fund with the 0.15 expense ratio ends up valued at over $55,000, while the other fund with the 0.75% expense ratio ends up valued at over $46,000. That's a difference of over $8,500. And this is just showing a simple example with only $10,000 invested. As you can probably imagine, those fees only become larger as the size of your investments do as well. You'll see later that one of the S&P 500 ETFs we'll go over shortly has an expense ratio as low as 0.02%, which is really good. And the final reason to invest in an S&P 500 ETF is the long-term growth these funds offer. For example, if you had $10,000 invested in SPY since August 1st of 95, and I can only go back to August of 95, the data I had available, even though the fund originated in January of 93. Well, back to where I was. If you invested $10,000 in SPY in August of 95 and had your dividends reinvested, also known as DRIP, that $10,000 would have grown to over $150,000 without investing any more into the fund, not even another penny or even a lot of pennies. Now that we've gone over some of the reasons to invest in an S&P 500 ETF, including the great returns these ETFs have had historically, I want to point out that these ETFs are also part of many seasoned investors' portfolios as they are great to invest in and just leave them alone for years or even decades. So what are some of the available S&P 500 ETFs and how do they differ? And which one may make the most sense to invest in for you? First up, let's go with the grandfather of them all, and that would be SPY, which I mentioned earlier was created in 1993. It's the largest of the S&P 500 ETFs, holding over $526 billion in assets. Second on the list is the next oldest, which is IVV, which has been around since May of 2000. It's also the next largest holding, over $450 billion in assets. The third ETF in this group is arguably the most popular of late, and that is VOO, which is the youngest of the group, starting in May of 2010. It's very close to the amount of assets it has as it trails IVV closely, holding $432 billion in assets. And the last one of the group I'm going to mention is SPLG, which was created in November 2005 and has by far the least amount of assets at $33 billion. All four of these have almost identical portfolios in regards to their investments, and their performance is almost identical over the last 10 years as seen in this graph. So what's the difference then? Basically, you have three different investment groups in State Street, which maintains SPY and SPLG, Vanguard, which maintains VOO, and iShares maintaining IVV, and they all want a piece of your business by offering an S&P 500 tracking ETF. There's also some differences in the expense ratios. Remember, we talked about those earlier. All four of these have really low or good expense ratio. Both VOO and IVV have a 0.03% expense ratio. SPY has the highest expense ratio at 0.09%, while SPLG comes in with the lowest at 0.02%. So if SPLG has the lowest expense ratio and it pretty much has the same assets in the portfolio as the rest, then why would you invest in the others? That's a great question. It could be that you don't have access in your brokerage account to State Street funds, or maybe you have an allegiance to certain companies like Vanguard. State Street likely also created SPLG, so they had an option at a lower price point, since the other three all came in with a price of $480 or more per share as of April 2024. And being able to buy fractional shares is a relatively new feature, so there were likely some that saw the share price of SPLG being much more attractive than the price of the others. Ultimately, the choice is yours on which one makes the most sense for you. But for your reference, here's a nice table summarizing all four of these ETFs. I also wanted to mention there are a lot of variations of S&P 500 related ETFs that may focus on growth, like SPYG, or VOOV, which focuses on value. There's even an ETF named RSP that equally weights all 500 companies, so each company in that ETF is about 0.2% of the portfolio. Well, that's it for this video. I hope what we discussed helped clarify how easy it can be for you to start investing in the stock market using ETFs that track the S&P 500 index. They're a safe bet based on past history and continue to be a great long-term investment. As always, thanks for watching and hanging around to the end. Don't forget to like the video and subscribe so you know when I put out new content focused on your money and how to manage it best with a little bit of comedy thrown in there for good measure. See you next time.